we will see in this section. Agency cost is the cost that arise when there are conflicts of interest between stakeholders. Here we have bondholders and stockholders. When there is a conflict of interest, agency cost arises. Separation of ownership and control, always it is a feature of the corporations or companies. What does it mean? It means the company is not managed by the owners and the control is done by outside managers. Therefore, owners always owners or investors, they want their benefit but they don't manage. And the managers who manage the company, they are not the owners. This is what the peculiar feature of the companies. Managers make decisions, they may make a decision that benefit themselves most of the time. At the expense of whom? At the expense of the investors. Sorry. So, because it is not their investment, it's not their money, so they might benefit themselves at the cost of the investors' money, and they might also reduce the efforts. They might spend excessively on the perquisites, benefits, and they might engage in empire building. You make it a point. Big companies might not be profitable companies or value added companies. So the manager's objective might be to increase the market share, to increase the only empire building at the investment of the investors. So before making any new investment, they have to take care of all the long-term investment decision criteria. But they might be only crazy for empire building. Whether it is positive NPV or negative NPV, they don't care. All these scenarios, the agency cost increases. Managerial entrenchment. It arises as a result of separation of ownership and control, in which managers may make decisions that benefit themselves at the investor's expenses. If these decisions have, as I told you in the previous slide, they might make long-term investment decisions even though the investment is creating a negative NPV for the firm. They are just crazy for increasing the empire. They are a form of agency cost because that destroyed the value. Negative NPV means destroyed the value. Debt provides incentive for managers to run the firm effectively and also efficiently because the debt holders take a particular fixed rate of interest. So if the company has debt, definitely the company has to pay that interest. They cannot fail to pay the interest because interest is fixed and it is to be paid. Otherwise, the company can go for liquidation. Therefore, debt is there means managers will be more active and more efficient. Ownership may remain more concentrated, improving monitoring of management. So, since interest and principal payments are required, debt reduces the funds available at management's discretion to use wastefully, isn't it? Because the company has to pay the interest. As I said you, interest is obligatory. It is must be paid. It must have to be paid. If they are not paying, the debt holders will drag to the court. Therefore, managers will be more effective and more efficient. Equity debt holder conflict. Now it is the debt equity holders conflict also a part of agency cost. A conflict of interest exists if investment decisions have different consequences for the value of equity and the value of debt. Most likely to occur when the risk of financial distress is high. You know, if the investment is taken at the uh, uh, debt investment or debt financing, definitely the work is going down. But at the same time, the financial distress is increasing. So here conflict of interest comes. We have seen in the very beginning. You have seen here, if you are taking 100% equity, the equity holders are getting only 15%. If you are making 80% equity, 20% debt, the equity holders are getting 17.5. If you are making 50% debt, 50% equity, they are getting 25%. If you are making 80% debt and 20% equity, they are getting 55% return. That means more and more debt means equity holders are getting more and more return, incentive. That means equity holders are getting more incentive, debt holders are getting more penalizing, maybe distress is increasing. You are having 80% debt for getting this 55% return, or 50% debt for getting 25% return. For getting high return, sometime the equity holders might be uh, forcing the managers to take more and more debt. Again, conflict of interest. Again, conflict of interest. So managers may take actions that benefit shareholders but harm creditors. As I have shown you now, debt holders have very low in control in the company. They don't have voting right. So to make the shareholders happy, sometimes this kind of decision might have been taken. The debt holders are 80%, so that the equity holders are getting 55% return in a normal economy. So to make them happy, the managers might ignore the debt holders' interest. They only might take care of the equity shareholders, and conflict of interest arises. Similarly, excessive risk taking. 80% debt and 20% equity means excessive risk taken. Sometime, and the money is borrowed and it is invested in a very risky project. This is also not good for the project, good for the company. Sometime, under investment problem, the opposite of excess risk taking. They might not invest. They don't take any debt. There is no interest pressure, and they don't take any risky project. Because why to take risk? Just easy going process under investment problem. All these kind of thing. Too little leverage, too high leverage. Both are not good for the agency cost. One way you are increasing financial distress, another way you are not taking the ITS. In the blue zone, you are not taking the ITS, interest tax shield. In the orange zone or yellow zone, you are not taking care of the financial distress. So both are not good for the company. You should have a debt D star or a balance. The balance is what? The balance we have seen here as the value of lever or optimal capital structure. Once the cost of the value going down, there you should stop. That should be your optimum point. As debt increases, farm value increases, interest tax shield is there. So improvement in managerial incentive also there, because the debt increases the farm value. So equity debt holder conflict always remains. Always managers try to increase the debt so that the farm value will be increased. But at the same time, they are increasing the burden of interest burden. If leverage is too high, farm value is reduced by present value of financial distress cost and agency cost. The optimal level of D balance must be maintained, as we have seen in the previous graph. Asymmetric information, debt and the information. Managers' information about the firm and its future cash flows is likely to be superior to that of the outside investors. This may motivate managers to alter a firm's capital structure. They might not inform, and they might change the capital structure. They might increase more and more debt. Managers use leverage to convince investors that the firm will grow, even if they cannot provide verifiable details. Simply saying there is a very good growth opportunity, they might increase the debt. The use of leverage as a way of signal good information is known as signaling theory of debt. Like signaling theory of dividend, signaling theory of debt. If you are increasing debt, that means you are sending a signal that there is a good investment opportunity ahead. Market timing. Managers sell new shares when they believe that stock is overvalued and rely on debt and retained earning if they believe that stock is undervalued or it will be issued at a discount. So when there is a possibility of issue at premium, they will issue the equity. If there is a possibility of issue at discount, they will not issue equity. They will go for issue of either retained earning, depend on retained earning, or issue of debt. That is called market timing. Adverse selection and pecking order hypothesis. Suppose managers issue equity when it is overpriced. Knowing this, investors will discount the price they are willing to pay for the stock. Managers do not want to sell equity at a discount. So they will go for either retained earning or debt. That is pecking order hypothesis. Pecking order hypothesis says in a normal scenario, you should first depend on retained earning, then you should depend on debt. Issue of equity should be the choice at last. That is the equity as last resort. How? Let us see a problem. Exxon Industries needs to raise 9.5 million for a new investment project. If the firm issues 1 year debt, it may have to pay interest at 8%. Though Exxon managers believe that 6% would be a fair cost of capital or cut-off rate or rate given as a level of risk. So 6% is the cost of debt. However, if the firm issues equity, the managers believe the equity may be underpriced by 5%. Now that market timing says that you will have to issue your equity at 5% discount. What is the cost to current shareholders of financing the project out of retained earning, out of debt, out of equity? So we will see what if it is retained earning, what is the cost? What if it is debt? What if it is equity? Let us do the solution. If the firm spends 9.5 million out of retained earning rather than paying as dividend to the shareholders as dividend, the cost of financing the project will be simply 9.5 million. There is no interest, no cost, nothing, because you would have paid as dividend. You convinced your shareholder to keep it and reinvest. So the cost of the project will be simply 9.5 million. Second option. Use, because pecking order says first retained earning, that is 9.5 million. If you are going for debt, 1 year debt will cost 9.5 million and your coupon payment is 8%. So 9.5 multiplied by 1.08, future value will be 10.26 after 1 year. 10.26 you will give after 1 year. The present value today is cost of capital is 6%. The managers believe. So 10.26 divided by present value factor 1 plus present value factor 1.06 will be 9.68 million will be the cost of it debt. If you are issuing debt, the project cost will be 9.68 million. If you are issuing retained earning, if you are depending on retained earning, your cost of project is 9.5 million. Debt will cost you 9.68 million. Let us go to the third one, last resort, equity. If equity is underpriced by 5%, that means it will be issued at 95%, discount 5%. Then to raise 9.5 million, you have to issue 10 million share, 5% discount. For example, if the firm shares are each worth 50, sells at 95% of 50 is 47.5 per share. It will need to sell 9.5 million means at 47.5 per share, you have to issue 200,000 shares. Market value will be 50, the book value is 50 per share. Therefore, 10 million shares you have to issue to get 9.5 million proceed, cash. Thus, the cost of financing the project with equity is 10 million. Your equity will be increased by 10 million. So, you have now three different opportunities available. One is either you go for retained earning, your project cost will be 9.5 million, or you go with debt, cost will be 9.68 million, or you go to equity, cost will be 10 million. Therefore, as per pecking order theory, if possible, go for retained earning. If retained earning is not sufficient, go for debt. Don't go for equity at the first choice. It should be the third choice or last choice. So now putting it all together, use the interest tax shield if your firm has consistent taxable income. If your volatility is less, if your debt is under control, then use debt to get the ITS benefit. Balance tax benefit of debt against cost of financial distress. Don't only biased with increasing debt to reduce the work, because definitely increase the debt means reduce the work. We have seen so many in the spreadsheet, very detailed we have seen, but balance the ITS and the financial distress cost. Consider short-term debt for external financing when agency cost is too high. Increase leverage to signal confidence in the firm's ability to meet its debt obligation. So, when you want to give a signal of confidence to the market, then you use the leverage or use the debt. Be mindful that investors are aware that you have an incentive to issue securities that you know are overpriced. You know the market is very well known, so well informed. Rely first on retained earning, as we have seen in the previous example. First of all, retained earning, then go for debt and equity as a last choice. Do not change the firm's capital structure too often unless it departs significantly from the optimum level. Otherwise, keep the capital structure fixed. Don't go with